When you look at a set of published financial statements, there is, this underlying expectation of absolute precision.
Right.
It looks like rigid, unchangeable truth, like structural engineering, basically. A company makes 10 crores in profit, or they buy an asset, and the spreadsheet just points and says, well, there it is. That is the objective reality.
See, it definitely feels that way. I mean, as humans, we find comfort in hard categorized numbers.
We really do.
We want to believe the math is simply the math,
Yeah.
and that a balance sheet is merely a mirror, reflecting the exact state of a business.
But then you step into the actual engine room of accounting, and suddenly, well, that precision is honestly a bit murky.
Oh, absolutely.
You realize these are living, breathing documents. They are heavily influenced by shifting rules, management's best guesses, and sometimes massive infusions of free government money,
Right.
which can completely change the entire complexion of a company's financial health.
Because what looks to an investor like, say, a sudden burst of organic growth could, in reality, just be a strategic tweak in an internal policy.
Exactly. Or a well-timed state subsidy that artificially inflates the bottom line for a quarter.
Yes, exactly. It happens all the time.
And that is our mission today. We are doing a deep dive into a stack of research and notes curated by the creator of today's source material, Dr. C. Nagadeepa, Associate Professor, Kristu Jayanti, deemed to be University Bangalore.
And her work provides an incredible roadmap to navigating these diagnostic muddy waters.
It really does.
Yeah.
So for you listening, we are going to demystify two major accounting standards today, an AS8 and an AS20.
Right.
And we want to show you how a simple change in a rule or a government grant fundamentally alters a company's perceived reality. So let us unpack this. An AS8 basically deals with accounting policies, changes in accounting estimates, and errors.
Yes, that is the core focus of the standard.
We should probably start by separating a policy from an estimate because, honestly, they sound like the exact same thing to a layperson.
They do sound similar, yeah. But the distinction is really the foundation of reading any financial report.
Okay, so what is a policy?
Accounting policies are the specific principles, bases, conventions, and rules a company chooses to use to prepare its statements. Think of them as the fundamental laws of gravity for that specific company's accounting universe.
Right.
A classic example of this is inventory valuation.
Meaning how a company decides what the physical boxes sitting in their warehouse are actually worth.
Exactly. A business could use FIFO first in, first out, which assumes the oldest inventory you bought is the first inventory you sell.
Okay.
Or they could use LIFO last in, first out. Though it is worth noting that LIFO is actually banned under IFRS, the International Financial Reporting Standards.
Wait, really? Banned?
Yes, because in times of inflation, LIFO can seriously distort your balance sheet. Or, alternatively, a company could just use a weighted average cost method.
And depreciation methods fall under these policies too, don't they?
They do. Choosing between a straight line method, where you spread the cost of a machine evenly over 10 years, versus a double declining balance.
Which aggressively accelerates that depreciation into the first few years, right?
Right, usually to lower early tax burdens. Those are all policies. They're the underlying structural rules.
Yeah. See, Dr. Nagadeepa's notes highlight a real-world example of this from a company called Antidote Ltd., and the numbers here are mind-blowing.
Let us look at the mechanical impact of that choice.
Right. So Antidote decided to change their inventory valuation policy from LIFO to FIFO.
Oh?
Under their old LIFO policy, their management estimated their 2002 closing inventory value at $11 million.
Right.
But when they applied the new FIFO policy to that exact same physical inventory, the value jumped to $13 million.
Wow.
So the physical boxes in the warehouse did not change at all. The business did not suddenly become more productive or sell more goods.
No.
But by merely flipping a switch on their policy, the inventory value on the balance sheet increased by $2 million.
And that is the illusion of accounting, isn't it? We have to ask why a company might do this and what the cascading effects are.
Because it's not just a vacuum.
Exactly. Because their closing inventory value went up by $2 million, it mathematically lowers their cost of goods sold for that year.
Oh, I see.
And if your costs look lower, your gross profit artificially inflates. An investor reading that income statement might think, wow, Antidote Ltd. had an incredibly profitable year.
Well, in reality, absolutely nothing changed operationally. They just changed the lens through which they view their warehouse.
That is exactly it.
That is just wild. It really is a chosen reality. Okay, so a policy change alters the fundamental rules of measurement. What is an accounting estimate then?
Estimates are basically Adjustments based on new information.
Mhm.
You are not changing the foundational rule. You are just updating your math based on the present status of an asset and its expected future benefits.
I am trying to wrap my head around how that is different in practice. Let me try an analogy.
Please do.
Changing an accounting policy is like changing the rules of a game from basketball to football. Suddenly, you cannot use your hands. The scoring system is completely different. The entire framework of the match shifts. But changing an estimate, that is just realizing your star player is going to retire in 3 years instead of 5.
That is a brilliant way to put it.
The game is exactly the same. The rules have not changed. But you have to adjust your strategy moving forward because your inputs have evolved.
I really like that framing. See, the framework remains intact. To bring it back to the balance sheet, an estimate change might be adjusting the provision amount for bad debts.
Okay.
Let us say you normally assume 2% of your customers will not pay their bills, but the overall economy takes a downturn. So you estimate that now 5% will default.
Got it. You have not changed any accounting rules.
Exactly. You are just updating your expectations based on a new economic reality. Or, say, you realize a piece of factory machinery is wearing out much faster than you initially predicted.
Which brings up a massive structural problem.
How so?
If changing a policy is like changing the rules of the game from basketball to football, how do you record that on the scoreboard without completely confusing the investors?
Yeah.
If Antidote Ltd. suddenly shows a $2 million profit bump, an investor comparing 2001 to 2002 is going to be totally misled.
This is where we get into what we might playfully call time travel in accounting. To maintain comparability, accountants use two concepts, retrospective and prospective application.
Let us tackle retrospective application first.
Okay, so when you change an accounting policy, you generally must apply the fix retrospectively.
Meaning we literally rewrite history.
You have to calculate and present the numbers as if the new policy had always been in place. You adjust the opening balance of retained earnings for the earliest period presented.
Wait, for those of you listening who are not CPAs, retained earnings is essentially the company's historical savings account, right? The cumulative profits they have kept over the years.
That is a great way to describe it, yes.
Yeah.
It is the accumulated net income that is retained by the company. So you adjust those historical savings, and you restate all the comparative figures for prior years that are shown in your current financial report.
So for Antidote Ltd., they cannot just drop a $2 million windfall into 2002 and act like they had a miracle year.
Absolutely not.
They have to go back and restate their 2001 numbers and their 2000 numbers using the new FIFO method.
Right, because it forces transparency. It allows the investor to compare apples to apples over a multi-year trend. And this retrospective restatement also applies to material errors.
The sources mention errors specifically. I imagine we are not talking about a misplaced decimal point on a $20 lunch receipt.
No. We're talking about material errors. An error is material if its omission or misstatement could genuinely influence the economic decisions of the users relying on those statements.
Like what?
This could be a significant mathematical mistake, a gross misinterpretation of facts, or outright fraud.
Wow, okay.
If a company discovers in 2024 that their 2023 sales revenue was overstated by 5 lakh rupees due to a calculation error, they cannot just quietly deduct 5 lakhs from the 2024 revenue.
Because that would distort the current year's performance.
Exactly. They must go back, reopen the 2023 financials, and correct the historical record.
It keeps the history honest. Now, contrast that with prospective application, which is used for changes in accounting estimates.
Right.
If I am following the logic, if retrospective is rewriting the past, prospective is basically saying, well, what is done is done.
Yes. You only apply the change to the current reporting period and future periods. You do not touch the historical savings account, and you do not restate prior years.
There is an example in Dr. Nagadeepa's notes about a company called Robust Inc. that I think perfectly illustrates the real-world impact of this.
Oh, the depreciation example.
Yes. Let us say Robust Inc. buys a piece of heavy-duty equipment for $400,000. On the day they install it, management estimates it has a useful life of 10 years.
Okay.
And at the end of that decade, they figure they can sell it for scrap for $40,000.
So their depreciable base, the amount they need to expense over time, is $360,000.
Right. And if they spread that evenly over 10 years, they are deducting $36,000 a year in depreciation expense.
Simple enough.
But 4 years later, they bring in technical experts to evaluate the factory. The experts look at this machine and say, actually, this thing is taking a beating.
Right.
It only has 7 years of life left, not the 6 we originally thought. And the scrap value is now going to be $46,000.
Okay, so since this is a change in estimate, like your star basketball player retiring on a different timeline, we handle it prospectively.
But how does an accountant actually transition the math without breaking the balance sheet?
It requires finding your new starting line, which we call the net book value. Net book value is essentially what the asset is worth on your books right now after you have accounted for the wear and tear of those first 4 years.
Okay, so they depreciated $36,000 a year for 4 years. That is $144,000 of accumulated depreciation.
Yes, so we subtract that $144,000 from the original $400,000 purchase price.
Which gives you a net book value of $256,000 at the start of year 5.
Exactly. That is your new reality. Now, you take that $256,000 and you subtract the new revised scrap value of $46,000. That leaves you with a new depreciable amount of $210,000.
And since the experts said we have 7 years of life left, we just divide that $210,000 by 7, which gives us a new annual depreciation of $30,000 moving forward.
See how seamless that transition is? You do not go back and tell investors, hey, our profits for the last 4 years were slightly wrong because we depreciated too much.
Because it was not wrong at the time.
Exactly. The past was based on the absolute best guess at the time, made in good faith. The future is based on the new best guess. It basically reflects the reality that business conditions are dynamic.
Right. Now, we have spent a lot of time looking at how companies manage their own internal numbers, their chosen policies, their evolving estimates, their past errors.
We have.
But business does not happen in a vacuum. External forces intervene, and the biggest external force is usually the government.
Oh, without a doubt.
Which brings us to the second half of our deep dive. In AS 20, which governs accounting for government grants and disclosure of government assistance.
This is arguably one of the most critical standards for businesses operating in developing or rapidly industrializing economies. And AS20 draws a very strict boundary between a grant and assistance.
Okay, what is the difference?
Well, a government grant is a direct transfer of resources to an entity in return for past or future compliance with certain conditions.
Simply put, the state gives you actual money or tangible physical goods, but there are compliance strings attached.
Exactly. So getting a massive subsidy to build a microchip factory provided you hire 1,000 local workers.
That is a classic grant.
Right. Government assistance, on the other hand, is an action designed to provide an economic benefit, but it does not involve a direct transfer of monetary resources that you can easily drop into a spreadsheet.
Like what?
Think of the government providing free technical marketing advice to rural farmers, or the state setting minimum support prices for agricultural crops to stabilize the market.
It is undeniably helpful, but you cannot easily put a definitive, standalone monetary value on market stabilization for your balance sheet.
Which is why government assistance is generally just disclosed in the narrative notes of the financial statements, rather than accounted for as a hard numerical value like a grant.
Okay, but I have a question about the gray areas here.
Sure.
Because governments love to structure things in complicated ways. Let us say a government agency gives my manufacturing business a loan to expand.
Okay.
But the contract says if you hire 50 people from the local village and keep them employed for 3 years, we will forgive the loan. You won't have to pay it back. Is that a liability because it is a loan, or is it a grant?
The standard refers to that specifically as a forgivable loan. Initially, it might be recognized as a liability. However, it is treated as a government grant if there is reasonable assurance that the entity will meet the terms for forgiveness.
No, I see.
Once you officially meet those conditions, say you hire the 50 people and hit the 3-year mark, the lender waives repayment. At that point, the liability is extinguished from your balance sheet, and it is recognized as a government grant.
It literally transforms from debt into free capital.
It does.
Let us look at how this plays out in the real world, because Dr. Nagadeepa's research provides a fascinating look at the Indian ecosystem specifically.
Yes, the Indian context is very vibrant here.
I was looking through the list of government support programs she compiled, and the sheer volume is staggering. You have the Startup India Seed Fund, incubation centers through the Atal Innovation Mission, targeted support for SaaS startups through Samareed, Enize Prayas for innovators, PM Suryagar for solar.
It highlights how heavily governments engineer economic growth. They use these grants to incentivize very specific behaviors, from high-tech innovation to grassroots agriculture. like that massive 1,022,528 crore rupee allocation to the Department of Agriculture.
Exactly. But rather than just listing all the schemes, I want to zero in on how a business actually records this money because the accounting choices are fascinating.
Let's do that.
Let's take a specific example from the source material. A scheme from the Karnataka Minorities Development Corporation. They offer a 50% subsidy, up to 3 lakh rupees, for eligible entrepreneurs to buy vehicles like auto rickshaws or small goods trucks.
Right. Let's say an entrepreneur gets this subsidy. Or, to scale it up, a mid-sized factory gets a massive grant to buy a heavy piece of machinery. How does that grant actually hit the books?
Under NAS 20 for grants relating to assets like the auto rickshaw or the factory machinery, a company basically has 2 permissible methods of presentation.
Okay, what is the first one?
The first is the net cost method. You simply deduct the grant directly from the purchase price of the asset.
So if my heavy machinery costs 20 lakh rupees and the government gave me a grant of 5 lakh rupees, I just show the machinery on my balance sheet at a net value of 15 lakh rupees.
Yes. And the cascading effect of that is in your profit and loss statement. You only calculate your future depreciation on that reduced 15 lakh amount.
So your depreciation expense is lower every single year.
Exactly. It is a very clean, straightforward method. The asset's carrying value reflects what the company actually paid out of their own pocket.
That makes perfect sense. It is simple. But you said there are 2 methods. What is the alternative? The alternative is the deferred income method. Here, you show the machinery at its full gross value of 20 lakhs on the asset side of your balance sheet.
Wait, you do not deduct the grant?
No, you do not. Instead, on the liability side of your balance sheet, you record the 5 lakh grant as a deferred government grant.
Okay, wait. Why would a company choose this complicated second method? If the net method is so clean, why put a 20 lakh asset on one side and a 5 lakh liability on the other?
It basically comes down to optics and financial strategy.
Optics.
Yes. By using the deferred income method, your balance sheet looks physically larger, you're showing more total assets.
Ah, I get it.
For a growing company looking to secure additional bank loans or attract investors, showing a 20 lakh asset base might look much stronger than a 15 lakh asset base.
So it is about signaling scale and control over larger resources.
Exactly.
But what happens to that 5 lakh liability sitting there? It isn't actually debt they have to pay back, right?
No, it is not debt. This is where the income statement gets involved. Each year, you recognize a portion of that 5 lakh grant as income, usually matching the depreciation schedule of the asset.
Okay, walk me through that.
If you are depreciating that 20 lakh machine over 10 years, you're taking a 2 lakh depreciation hit every year, right?
Right.
Well, you simultaneously release 50,000 rupees of the deferred grant into your profit and loss statement as income.
So you have a heavy 2 lakh expense, but you cushion it with a 50,000 rupee injection of other income every single year.
Yes.
Yeah.
Mathematically, the net impact on your final profit is exactly the same as the first method. But the story it tells the investor is entirely different.
One story says we have a cheap asset. The other story says we have a massive asset and we have a steady stream of secondary income.
You have hit the nail on the head. It provides flexibility depending on the narrative the company wants to present, while still adhering to strict mathematical realities over the life of the asset.
That is just brilliant. Now, those are grants for buying physical assets, but the government also gives grants just to cover expenses or losses, don't they?
They do.
The source text includes an example called Problem 1, where a business receives a 2,000 rupee grant specifically to compensate for losses in their export business.
Right, these are grants relating to income. And just like asset grants, NAS 20 gives you 2 options for disclosure.
2 options again, okay.
The first is gross disclosure. You present the 2,000 rupees clearly as a separate line item in your profit and loss statement, usually under a heading like other income.
So it is fully transparent. Anyone reading the statement knows exactly how much government life support the company received.
Yes, very clear. The alternative is net disclosure. Here, you deduct a grant directly from the related expense.
How does that look in practice?
There is another example in the notes where the government reimburses 50% of a 1,000 rupee employee training cost.
Nope.
Under net disclosure, you would take your total training expense, deduct the 50,000 rupee grant, and just show a net training expense of 50,000 in your P&L.
Which, again, hides the government's involvement a bit. It just makes the company look like they are incredibly efficient at training their employees for cheap.
Exactly. The flexibility embedded in these supposedly rigid rules is pretty astounding.
It really is. We have covered incredible ground today. We started by unpacking how changing an accounting policy forces a company to time travel and restate their past, ensuring investors can compare historical data without being fooled by rule changes.
And we contrasted that with accounting estimates, which are forward-looking adjustments that acknowledge the dynamic, unpredictable nature of business operations.
From there, we navigated the complex world of government grants. We discovered that whether a company gets a subsidy for an auto rickshaw or a massive export bailout, they have profound choices in how they present that windfall to the world.
Right, they can shrink their asset costs, or they can inflate their balance sheets and drip-feed the grant as income.
It highlights why reading financial statements requires so much more than just looking at the final profit number. For you listening, whether you are evaluating a startup's pitch deck, deciding whether to invest in a publicly traded stock, or just trying to understand how the corporate world operates, knowing these mechanics is the ultimate superpower.
Absolutely.
Knowing whether a sudden jump in profit came from a brilliant new product, a strategic change in an inventory estimate, or a massive government grant that is what separates the casual observer from the truly informed analyst.
I would leave everyone with this final thought to mull over.
Go ahead.
We discussed how accounting rules allow companies to choose between presenting a government grant as a reduction in their expenses or as a sudden boost in other income.
Right.
We also saw how choosing FIFO over LIFO magically increased Antidote Ltd's inventory value by $2 million without them doing a single extra ounce of work.
Yeah, that was crazy.
If the rigid rules themselves offer this much choice, how much of a company's growth narrative is driven by operational success, and how much is simply a matter of clever presentation?
Wow.
The next time you read a glowing earnings report, ask yourself, are you seeing the raw, unvarnished reality of the business? Or are you just looking at their chosen policy?
A perfect, slightly unsettling reality check. The scoreboard might say one thing, but understanding the rules of the game tells you the real story.